All right, so let's start talking about credit scores. I think you are all familiar with a credit score because they're in so many advertisements about improving your credit score. Keep in mind there are three different agencies. They use slightly different ways to calculate your score, but they all are basically scaled the same way. A good credit score is 700 or above, and obviously the higher above 700, the better off you are. So here are some facts about using your credit score. It determines whether you get credit, and not only does it determine whether you get credit, it also determines what interest rate you pay. The lower your credit score, the higher the rate you're going to pay. Now, it is true that credit scores can change. In fact, in the next slide, I'll tell you what you can do to improve your credit score. But as long as your score is low, it's going to be a problem. The next sad truth is that your credit score is used for more than just determining whether you get a loan. Companies will often check your credit rating to see what your score is before they hire you. The assumption being if you have good financial habits, which will lead to a high credit score, you're more likely to be a trustworthy employee than if you have a low credit score, which would signal bad financial habits. Now, we know that's a gross generalization, and there are plenty of cases where that's not true, but it's true enough that companies use it. And I'm going to illustrate to you later in the presentation that getting a bad rate on a loan can make a tremendous amount of difference in the total amount that you'll pay for the loan. And this gets back to my comment about people with good financial habits are subsidized by people who have bad financial habits. And you'll see that very tellingly in some different statistics. Okay, so how do you get a better credit score? Well, your first question is, how do I get a credit score in the first place? Because without any sort of credit, you typically won't get the people won't loan you money so that you can establish credit. There are ways to do it. You can get your parents to sign on cards, co-sign on cards. Banks will issue it then. Sometimes you can go to a bank and they'll have what's called a secured card, and it basically says you give them $1,000, which they hold, and then they'll give you a credit card with $1,000 limit, and you use that successfully for 6 months to a year, and then they'll offer you a conventional credit card. Sometimes also some stores will offer credit cards to people who don't have any credit history, so you can take advantage of that. Now, what about improving your credit score? Well, obviously the number one thing is to pay your bills on time and also don't use your credit limit. Remember how I said never borrow as much money as someone will loan you? My credit cards have like $25,000 credit limits on them, but I typically run $3,000 to $4,000 a month. So they say keep your usage of your credit line below 30%. Incidentally, I never asked my bank to up the credit limits on my credit card. They just keep giving me higher and higher limits as they see responsible usage. Don't just open cards because you can. I maintain two different credit cards, and my wife has a few store accounts, but that's it. We probably have four total or less. And then don't go changing cards. One of the mistakes people make is they'll cancel a long-standing credit card, and that just wipes out all the credit history you have with them. So I don't hop around when it comes to credit cards. Not surprisingly, the two most important things it considers is what's your payment history? Do you have a history of paying on time? And how heavily you draw on your credit rating. Again, that's that 30%. Don't use all that they'll give you, and don't max yourself out. You should periodically check your credit score. You see this annualcreditreport.com, and you can get it free once a year. But also today, most banks will run, if your bank will give you your credit score. And so it's not hard anymore to get an accurate credit score. But again, this website is what you can turn to get it once a year for free. We've already talked about why the score matters. Let me illustrate to you why it matters. And this again, remember this? People with credit, bad credit, give money to people with good credit. Incidentally, one of the other things I didn't talk about is when they quote car insurance rates, they will usually do a credit check on you. Again, the assumption being if you have a low credit score, you're also likely to be a bad driver. Not true necessarily, but that's how they do it. So let's look if you want to buy a car at what compound interest will do to you. This is to show you the difference in what people with good scores pay versus what people with bad scores pay. So new car loan uh, with good credit, this is where you see that 0% or 1% car loans. With bad credit, you can see you're paying something like 10 or 11%, and it's even worse on a used car. So let's look at buying a used car. 2016 Toyota Camry, lightly used. Actually, this is probably based on it being a new car because it's very rare that you would see someone give you a 66-month term. Incidentally, how long is 66 months? That's 5.5 years. And so if you don't keep that Camry for at least 5.5 years, you're going to still owe money on it before you're ready to get a new car. But anyway, let's go in and let's look at the difference. Somebody has a good credit score, they get a 1.99% interest rate. Somebody has a bad credit score, they get a 14.99% interest rate. They are both paying off a $23,000 principal. However, you can see the difference in the interest paid. And so that person with the bad credit pays $9,600 more. Okay, let's look at that for a house. Those numbers, I have to tell you, they're pretty stark. Those are very different rates. Much more realistic to look at a house. 30-year mortgage, $150,000. Good credit, very good credit, 800, 4.5%. Obviously today the rates are much lower than that. But 620, not terrible, but okay, 6.2%. Look at the difference in the monthly payments, $150 difference. Over the life of that loan, the person that paid 6.2 versus 4.5 is going to pay $57,000 more money. Again, this is why people with bad credit are subsidizing people with good credit. We've talked about compound interest and how it can crush you. In the next video, I'm going to talk about using compound interest to your advantage.